Hello, hello, hello. Welcome to Al Stock Trades. This is going to be a very quick video here. We're going to go ahead and share with you guys some things. We have some announcements to make. This is a very important video. So, for the past couple of months, we've been working on a project. A lot. Don't buy solar panels, I guess, right? My apologies here. We've been working on this project for quite some time. It's definitely taken a lot of work, and we wanted to go ahead and share our results. But just some quick announcements. We have been inputting a lot of data within inside of our All Stock Alerts platform. We've been engaging a lot of information, hedge fund information that unfortunately would cost, 5 to 10 grand a month to acquire. Because of that, we will be increasing our prices to $30, $29.99 a month for the Al Stock Alerts. And we're going to be also increasing our Mastering Stock Market course at the end of the year. To all members that are already enrolled, you are grandfathered in to your monthly subscription and your lifetime access. But without further ado, I can't wait to share with you why the sudden increase and why this platform just got 100 times better. All right, so we just added a legendary backtesting model. Backtesting models use computational algorithms to essentially go back in time and basically apply a strategic set of criteria and strategy to see how would that weather a particular your performance. And we compare performance with the S&P, NASDAQ, Russell 2000, and the Dow 30. So in this regards, I did want to just bring the camera back to me really quickly. The title of the video here, or the picture, is of this hedge fund called Renaissance Technologies. We are going to be making a separate video regarding this particular hedge fund. It was created by Mr. Simmons, a profound mathematician at MIT, who was able to crack the stock market and get returns of more than 30% year over year for quite some time. In fact, Warren Buffett even says this gentleman is a genius. He's worth approximately $26 billion. Back in the 80s and 90s, computers were expensive. I mean, if you remember back in the day, plasma TVs were like $10,000. Over time, through deflation and through other means, technology becomes cheaper, and it allows a lot of folks to essentially have computational and acquire computational power at a lower cost. And this is the goal of our stock trades, is to essentially democratize financial information and provide high quality research analysis to essentially retail investors. So this is exactly the mission of what we're doing. And I can't wait to show with you the performance of this back tested model here. Overall, just to very quickly zoom in really quickly here, we basically talked about how, well, first off, let me just show you the back-tested model. This back-tested model here will show what stocks it picked, but it outperformed the market. Here's the portfolio gains. The top is the back-test model. The yellow is the NASDAQ. And the green here, the itty bitty widsy tiny green, is the S&P 500. And as you can see, the model crushed the living god out of the S&P and the NASDAQ. And here are the results here from 2006. You can see the portfolio gain versus the S&P 500 gain versus the NASDAQ gain versus the Dow and the Russell. And if you scroll all the way down to overall, the portfolio of this backtest model be 10x'd in a span of 16 years. Now, again, when something's a scam when someone says you can 10x in 2 months. That doesn't happen. And when it usually does, it's a scam, Ponzi scheme, crypto, you name it. If it goes up, it'll come back down really quickly. We're going to explain how this is generated. But overall, it's an average of 12 to 20% returns year over year on average. If you were to average this out, and even 8 to 9% returns per month. But as you can see here, this model has done terrible this year, but if you compare it to the S&P also has done terrible and a lot worse than the NASDAQ. Overall, it's crushed the S&P, which we'll talk about. But before we get into the details of all this, and we'll show you, in fact, let's click on it here right now. Let's open it up here so we can show you the devil's in the details here. Let's just go ahead and read this really quickly. So again, for the past 230 years, Wall Street has always hidden in the shadows. It's always been essentially stealing money from the retail investors. And, a lot of retail investors are financially illiterate. And not just that, they don't have the data. I mean, if you just open up Robinhood, what's really on Robinhood, right? The price, volume, maybe a couple simple moving averages if you're on the computer, right? There's really not a lot there. And there's not a lot of computation. So it's unfortunate retail investors lose in the game because they don't have the necessary tools. They're trying to basically, it's like basically taking a water gun to a atomic bomb fight. That's literally what it is. You're going to lose. So I wanted to break this down because we want to strive to educate retail investors. On average, there are 4 levels of investors. The first level are speculators, those who like to join groups and copy others, such as GME and AMC. They don't know nothing about the fundamentals. They just listen to the crowd and they go with the crowd. The second level of investors understand free cash flow. They know how to use free cash flow. But the thing is, there is another level of investor, and that is a macroeconomic. Essentially, this investor is able to take macroeconomic data that predicts recessions and strategically modify their portfolio. So let me go ahead and open this up and so I can show you. The next level, unfortunately, I have not achieved this level yet. This is a level that Warren Buffett is in. And if you don't know that much about stocks, think of like Michael Jordan, Kobe Bryant, Mahatma Gandhi, Muhammad Ali. These are obsessives. They understand it's like the difference between a cook and a chef. A cook can follow a recipe and is able to essentially follow a recipe and get to the result. A chef knows how to break down the inherent spice profiles of the dish and decompose it to its first principles, and is able to reconstruct another dish by using different types of spice modalities, as the chef is a master of the spices and is able to make something different. That is level 4, and it takes so long to get there, and I haven't gotten there, and I'm working hard to get there. In this regards, that was a kind of a good analogy there between a chef and a cook. All right. So, there's someone can just type in numbers in the intrinsic value calculation, but if someone doesn't understand the inherent value, and the competitive advantage, the moat, the whole spectrum of an investment, is most likely is a cook. All right. So now let's go ahead and go to the recession, and I'm going to explain to you what I mean. So let's go back down. And let's just really quickly here show you a couple of things here, okay? Now, if you go ahead and look at this, I'm going to see if I can do this back test here. All right. I'm trying to see something here. Okay. So overall, if you look at the back test that we have here, okay, if you zoom on lower, you can see that the back test lost money in 2008. So if you go to 2008, the back test lost money. Okay, and I'm going to explain to you how this back test works. But the back test lost money. What happens if I told you there's a way to avoid this loss? Well, all you have to do is look at the recession indicator. This is where I tell you this is between a level 2 investor and a level 3 investor. A level 3 investor is able to take macroeconomic data that can predict recessions. Well, this is the recession predictor part of the Mastering Stock Market course here. And what you can see here, if you go down, forget any of this, but let me just kind of teach you. Every time the red line and blue line hit the black line, there's going to be a recession. Red line, blue line hit the black line, recession. The gray obviously is a recession. You can read here. Great. Let me zoom in. The gray is a recession. Great. And every time the red and blue line, the colored lines hit the black, recession. Colored lines hit the black, recession. And guess what? The colored lines are hitting the black now. And the administration says we're not at risk of a recession, but history says something else. Okay. But enough with that. Let's go ahead and let's kind of zoom in here. Okay. So if you go between 2002 and 2009, you would have been able to predict a recession because it hit the black line by 2006. 2006, and the deeper the inversion, the deeper the chaos. And literally by 2006, you need to be out of the market. Okay. And then you could have been out, and you honestly, most folks just go ahead and that's when they're like, okay, I'm going to go in and I'm going to get out of the market and I'm going to wait this out. And I'm just going to keep the ones that intrinsically are undervalued. Okay. Because remember, this model doesn't take into account you doing an intrinsic value calculation on the model itself, which will then give you even a higher edge. So not only would you essentially 10x, you would probably 14 to 15x. And again, $1 million put in 2006 using this model would have generated $11.25 million. Okay. So then that is basically, hey, how are you doing, my friend? How are you doing? I hope you're enjoying this. There's a lot of information here. So based off of this, 2006, we're out. So let's go to here. So 2006, we would have taken our 11% gain. We would have missed out on a 10% gain here. But then guess what? We would have avoided a 40% gain. And as soon as the market hits a recession, you would have gained not 46%, you would have gained more than 46% because you would be buying from this direction. It would have been like 100, 150%. And the next year after that, 57%. Okay. So you can see how doing an inverted yield curve can assist you and can help you avoid problems. And then again, that's a level 3 investor. Okay. But overall, what is this? Like, what is this back-tested model? So let me explain it to you quickly right now so you can, understand. What this back-tested model does is it basically goes in and searches all of the world's best hedge funds by inception, not by they've performed really well in a year or 2 years like Cathie Wood's. No, I want hedge funds back record like Renaissance, right? That has performed better than literally since 15, 20, 30% since inception. Okay. The problem is the ability to get these data is only other hedge funds can have this. And if you were to get this data, it would cost you as just an individual investor, I would say anywhere between $300 to $500. How shameful is that, right? I mean, most people's portfolio isn't, most people start off with a lower portfolio. They can't even get in with that much. I mean, let's assume, you're an early 20-year-old, 19-year-old. You think you have money to pay $400, $500 a month for just one little resource to put in all the other resources you have to get? And we get this data, and what it does is it cycles. Every 12 months, it gives you a brand new 20 stocks. And all you have to do is you could just buy those stocks and wait on the sidelines and then rinse and repeat. If you want to amplify your returns, you would go in and analyze those stocks, do an intrinsic value calculation, and assess the GF score, which will look at whether if it's overvalued, undervalued, X, Y, and Z. We'll show you an example here. Okay. So we're going to go in and we're going to zoom in on here. Okay. And this is why we're increasing our prices. This type of data is expensive, and we want to bring it to our retail investors, especially to all of our Mastering and All Stock Alerts members. Okay, so if you go down here, this is 2006. Okay, these are the tickers. So these are the titles. Okay, and these are the tickers. Okay, there are about 20 tickers. Wait, my apologies. On average, there's 20 tickers. But if it doesn't find good tickers, it won't use up the 20, if that makes sense. So for this year, it only found 1, 2, 3, 4, 5. It found 5 tickers in 2006 based off of the computational model. And that year, it performed 11%, 11.65%, which you already know because that's what this is here, 11.65%. Okay. So I'm hoping this makes sense. Okay. Then in 2007, because remember, this is all it is just 12 months. 12 months. Then it gives you a new set of tickers. Okay. And this one performed 10%. Okay. Now we can just go ahead and pull up one ticker here. Let's pull up ROP, ROP, ROP. And this was back in 2006. So we would have to go back then. Okay. Go back to ROP. Now it's a $438 stock. Back then it was a it was a $39 stock. Now it's a $438 stock. You see what I'm saying? Going back though, all the way to 2006, when it was a $39 stock, we were here. We were here. Wait, let me get the exact date. January 1st. So January 1st, right here. It was around here. Literally a year after, right here, the stock went up 40%. Obviously, the other stocks went down, and it created a summary of 11% gain that year. But overall, just from here and here, I mean, just look at how much this has gained. Okay, so again, it gives you the stock, and then you rotate, and then ROP. Let's see for the next year in 2007. So ROP was gone. ROP is out. It's made its money and it's gone. Okay. Now these were the next stocks. So let's go ahead and scroll down and let's see. I'm if I was you, I would be like, well, what were the stocks for this year, right? Or last year too. Okay. So let's go down. And these are the stocks for 2021. And you can see Into, Google, FICO, all these. And then all of a sudden it switched, and these are the stocks for this year. Okay. Microsoft, Google, ASML, all these here. Okay. Apple. Okay. And overall, it was down this year 22%. It's been down 22%, negative 22%. So, but then last year it was up 41%, right? So, and you know this because you can see it here. It's down. This one says down 22%. It's probably the average. It's still, if you compare it to all the wins, it's negative 18.64%. And last year, since that year, because this year hasn't closed out yet, last year was 41.57. There's your 41.57. So you can see the power of computation. So now we can go in and take a look at AZO, AutoZone. So we type in AZO stock, okay? So AZO stock is actually up 19% for the year, right? And this is why this balance is out. Most folks aren't down 22%. Most folks are down like 50, 80%, 90%, some folks, right? So you can see the power of having this. And then I can't wait until January 1st of 2023 because we are going to get new batches of stocks. And this is why prices are going to be increasing because there's a lot of computational power that goes into this. Okay. So now let's quickly, AZEO, most folks would say, okay, I'm just going to hold this. But this is where you can use the fundamental analysis in conjunction with this Renaissance-like technology. And if you can go here and then go to our brain machine, which is our own proprietary tech, you go in here and you type in ALDCF, the DCF, and we can, what is the AZO? We can see what's the value of AutoZone, 3,700. Okay, 2,400. All right, let's go ahead and do another one. ADCF, AZO. Let's see what the price of this one is. 3,100. This one's 2,400, and it's gotten to 2,500 before. That was the highest, 2,600, near the 3,100. Then we can just do a very quick one here. AZO. Oops, nope. I typed in the wrong ticker. That's why nothing popped up. It's the computer's like, what language is that? Easy. This is a more for short term. If you want to do short term trades, this is a short term DCF for day traders. Yeah. So overall, then we would take these financials and we would put it in our mastering, and then we would see the risk of holding this one or not. Who knows? The computation may put this in 2023's holdings because it sure had them here in 2021. In fact, it had them both in 2021 and in 2022. So if we were to go to January of 2021, this thing's up 106%. You see how powerful that is? All right. So I hope this was helpful. I just wanted to share with you guys that, and also to our members, I hope you're watching this video so you can utilize this tool. Effective immediately once the holidays are over. We're going to have one more coupon code. And after this, we're going to be increasing our prices. The Al Stock Alerts will be $29.99. And the Mastering Stock Market course will be $1,499. And then after 3-4 years from now, the results will speak for themselves. And to all of our members that have put faith in us and supported our mission to democratizing financial information, my humblest thanks to you all. And my biggest thanks also is providing you guys the biggest discount that we're ever going to have. That's thank you so much for that, and I hope that you guys are going. I hope that you can say one of the best investments you guys made in 2020, 2021 was our platform, and we can't wait to work tirelessly hard to bring you data that normally hedge funds have for the past 200 and some odd number of years. All right, I'll see you on the next one.